You paid into Social Security for decades with money that was already taxed. You get to retirement. The government taxes your benefits again. Then your 401k forces you to withdraw money at 73. That withdrawal drags even more of your Social Security into the taxable column, and your effective marginal rate inside the 22% bracket on paper quietly climbs to 40.7%. Then Medicare sees the income spike and adjusts your premiums upward 2 years later, when you've already forgotten what triggered it, and there's nothing you can do about it by the time the bill arrives. 3 toll booths, 1 road, and every piece of standard retirement advice only told you about the first one. Here is what's actually happening with the numbers to prove it. Total U.S. Retirement assets stood at $49.1 trillion as of December 31st, 2025, accounting for 34% of all household financial assets in the country. Americans held $10.1 trillion of that in 401k plans alone. Every single pre-tax dollar of that is a deferred tax liability the government has already mentally spent. They are not going to make it easier to collect. My name is Tom. I run a channel called Lazy Investor. I spent the last 10 years building a business surrounded by accountants, fiscal attorneys, and people who read the actual tax code for entertainment. Multiple hundreds of thousands of my own dollars are invested. This is not theory. And what I'm about to walk you through is information I have never seen laid out in one place with the real math anywhere in mainstream financial media. The frame I'm going to use for this entire video is simple. Think of tax-deferred retirement accounts as a road. The government told you there was one toll at the end, one payment. You put money in before taxes, it grows, you pay income tax when you withdraw. One toll booth. That was the pitch. The pitch was incomplete. By the time you're actually driving that road in your 70s, there are 3 toll booths. And they're positioned so close together that hitting one almost automatically triggers the next. The toll booth was never where they said it was. Remember that phrase, because we're coming back to it. Let me walk you through all 3. I'm going to show you the math at each one, then I'll show you the reroute. In a few minutes, I'm going to show you the specific calculation on what happens when your required minimum distributions and your Social Security benefits collide in the same tax year. The number 40.7% effective marginal rate inside the 22% bracket is one of the more quietly devastating things I've seen in a tax document. But first, there's a slower, quieter problem that's been compounding for 40 years. It's the toll booth nobody built a sign for. Here's a story. A man named Harold worked the same manufacturing plant in Ohio for 35 years. He and his wife paid FICA taxes on every paycheck from 1972 to 2007. They never thought too much about it. The deal was obvious: pay in now, collect later. It was never written explicitly, but the original 1935 Social Security Act positioned benefits as retirement insurance, not a taxable income stream. They had a reasonable expectation that what came out of the system would reflect what went in. Congress changed that deal in 1983. Under President Reagan, and this is not political, both parties have maintained this. Ever since the Social Security amendments of 1983 created federal income tax on Social Security benefits for the first time. The Greenspan Commission, which designed the system, estimated this would affect roughly 10% of beneficiaries, only the high earners. The thresholds they set: $25,000 in provisional income for single filers, $32,000 for married couples. Above that, up to 50% of your benefits became taxable. A decade later, in 1993, Congress added a second tier. Above $34,000 for singles or $44,000 for married filers, up to 85% of your benefits become taxable. Now here is where the toll booth metaphor earns its place. Those thresholds were set in 1984 and have never been adjusted for inflation. Not once, ever, in over 40 years. The provisional income thresholds used to determine the taxable amount of Social Security benefits are fixed by statute and not indexed for inflation or wage growth. The intent behind using unindexed thresholds in the 1983 legislation was that eventually, over a long period of time, there would essentially be no thresholds and all Social Security benefits would become subject to taxation. Read that again. That was the intent. Written down. Congressional record. Gradual expansion by design. The IRS adjusts its income tax brackets every year for inflation. Those move. The Social Security provisional income thresholds, the ones that determine whether your retirement check gets taxed, are frozen. The mechanism is simple and lethal. Social Security benefits get cost of living adjustments every year. The Social Security Administration announced a 2.8% COLA for 2026. Every COLA increase raises the half of your benefits that counts toward provisional income. Your investment income grows, your IRA distributions grow, but the threshold that decides when taxation kicks in never moves. It was a one-way ratchet, and it was designed that way. Harold's son, Derek, just turned 68. He earns about $94,000 in combined provisional income from Social Security and a modest IRA distribution. Derek is not wealthy by any meaningful measure. He drives a 7-year-old truck and still has a mortgage. But by the 1983 standard, he is in what was supposed to be the top tier of American earners. What was a high-income threshold in the 1980s is now a middle-class income. A couple earning $96,000 today is in the same economic position as a $32,000 couple in 1984. Yet only the modern couple pays tax on their Social Security. The result is a quiet, automatic tax increase that catches more retirees each year. The taxable amount of Social Security benefits as a percentage of all Social Security benefit payments has grown from 12.2% in 1994 to 38.2% in 2022. That is a tripling in 40 years. Zero new legislation required. The frozen threshold did the work silently, automatically. The Greenspan Commission estimated that 10% of Social Security beneficiaries would be subject to taxation of benefits. A rule designed to affect only the wealthiest 10% of retirees in 1984 now captures roughly half of all Social Security beneficiaries. A Social Security Administration analysis projected that over 56% of Social Security beneficiary families will owe income tax on their Social Security benefits in 2050. Had these thresholds been indexed to inflation from their original levels using CPI, the single filer $25,000 threshold would be approximately $80,000 today, and the $34,000 upper threshold would be approximately $110,000. The actual 2026 thresholds of $25,000 and $34,000 are dramatically below the inflation-adjusted equivalent, meaning that a retired worker whose income today would have been considered middle income in 1983 faces full 85% taxability on their Social Security under a threshold structure originally intended for higher income retirees. The first toll booth was never where they said it was. Now you might be thinking, didn't the one big beautiful bill, the tax legislation Congress passed in July 2025, solve this? It added a $6,000 senior bonus deduction for taxpayers 65 and older. That sounds like real money. Here's the reversal. You think the senior bonus deduction repairs the Social Security taxation problem. It barely touches it. The IRS will continue to use the same formula it has used for the past 40 years to determine how much of your Social Security income is taxable. And unfortunately, the income thresholds have not been adjusted for inflation throughout the entire period. Depending on your income, anywhere from 0% up to 85% of your Social Security benefits can still be taxable. The underlying Social Security tax thresholds from 1984 remain completely frozen at $25,000 for singles and $32,000 for couples. This deduction is temporary and scheduled to expire after the 2028 tax year, and it phases out for single filers above $75,000 in income. The retirees who need it most often don't qualify for it. The formula that was designed to phase in taxation as a function of income, not adjusted for the 3 times inflation has grown, since remains fully intact. The big beautiful bill made permanent the lower tax brackets, the higher standard deduction, the estate tax expansion. Most TCJA individual provisions were set to expire at the end of 2025, which would have reverted rates to 2017 levels and triggered tax increases for roughly 62% of filers, according to the Tax Foundation. Keeping rates where they are was genuinely good news, but it did nothing about the Social Security provisional income formula. The first toll booth is still there. They gave you a discount coupon that most people can't use, that expires in 3 years. That doesn't change the underlying calculation. Stay with me, because this next part is where the math turns genuinely alarming, and it connects directly to the money sitting in your 401k right now. You're 73 years old, traditional IRA, Social Security coming in. You're in the 22% federal tax bracket on paper. You need $10,000 for an unexpected bill, medical, home repair, whatever. You pull it from your IRA. Your instinct, $10,000 times 22% equals $2,200 of tax. Standard bracket math. The actual tax bill on that $10,000 withdrawal, $4,070, 40.7% effective rate inside the 22% bracket. On paper, advisors often call this stacking effect a tax torpedo, a marginal rate spike triggered when each distributed dollar drags more Social Security into the tax base. Roger A. Young, Vice President and Senior Financial Planner at T. Rowe Price illustrated this using a married couple whose extra $1,000 IRA withdrawal added $407 in federal tax rather than the expected $220. The marginal rate on that withdrawal climbed to 40.7% because the same dollar pulled $850 of Social Security benefits into the taxable column. Here is the mechanical reason. Every additional dollar from the IRA drags another 85 cents of Social Security into taxable income. So each new dollar of withdrawal produces $1.85 of new taxable income. At 22%, $1.85 times 22 cents is 40.7 cents of tax per dollar withdrawn. That is not a marginal bracket. That is an effective rate nearly double what the IRS table shows you. The tax torpedo occurs when multiple income sources like required minimum distributions, Social Security benefits, and capital gains interact in a way that unexpectedly spikes your marginal tax rate. Without proper planning, retirees can find themselves paying much more in taxes than anticipated, even on relatively modest incomes. Here is a parable to show what this looks like in real life. A woman named Carol retired at 66 from a career in healthcare administration. She did everything the conventional script said, maxed her 401k for over 20 years, rolled it to an IRA at retirement, claimed Social Security at 66 because her advisor said not to wait past full retirement age. She had $980,000 in her IRA and was told she was set. Fast forward to 2026, Carol is 73. Required minimum distributions from traditional IRAs and 401ks begin at age 73 under current law. Her IRA, after continued growth, now sits at approximately $1.2 million. Her first year RMD, using the IRS Uniform Lifetime Table Divisor of 26.5 for age 73, is roughly $45,000. She receives $30,000 a year from Social Security. Her combined provisional income is now well above $70,000. 85% of her Social Security, $25,500, is taxable. Her income tax on the RMD alone is not 22% of $45,000. It's closer to 28 to 30% effective because the stacking effect pulls SS income into the calculation. And her actual marginal rate on any additional dollars she takes out is above 40%. She didn't do anything wrong. She followed the advice. The advice was optimized for the accumulation phase and had no model for the distribution phase. Here's the thing that makes this worse. RMD income frequently pushes retirees into higher IRMAA brackets, even if their spending hasn't changed. The result is bracket creep, or in some cases, a leap into significantly higher marginal tax rates. And the RMDs don't stay flat. On a $1.6 million traditional IRA, a first-year RMD is around $60,000, and the divisor drops every year after, forcing larger withdrawals as the balance compounds. If the account keeps growing untouched, first-year RMDs could be north of $150,000, taxed as ordinary income on top of pension and Social Security. The IRS table forces larger percentages of the account out every year, compounding the torpedo effect. And you have no choice. The penalty for missing an RMD is 25% of the shortfall. The IRS isn't asking. It built the toll booth right where the road narrows, and attendance is mandatory. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. The second toll booth was never where they said it was either. Here is the part that never makes it into a retirement calculator. Knowing these numbers is one thing. Having a specific sequence plan for navigating all three of them at once with your actual account balances, your actual Social Security timing, your actual Medicare exposure is something entirely different. I built something called the exit code, specifically because I couldn't find that plan anywhere else. It's a digital book built on 50 years of actual retirement data. Not generic advice, a mathematical framework. Two things inside it connect directly to what we just covered. The first is the dynamic withdrawal method, a replacement for the standard 4% rule that accounts for exactly the SS and RMD stacking we walked through, so you're not accidentally withdrawing yourself into a 40.7% effective bracket. The second is what I call the 58% rule, a calculation around the risk of a forced financial event in your late 50s or early 60s before you've had time to reposition your pre-tax accounts. That one hits people harder than any standard retirement model acknowledges because it assumes you control the timing. Often you don't. It's available through the link in the description. Less than dinner out. And every year you don't understand this math. The compound interest on ignorance is running in the wrong direction. Now, the third toll booth. This one doesn't arrive when the income hits. It arrives 2 years later. And by then, you cannot do anything about it. The subplot in this whole story, and I want to trace it through the rest of the video, is the question of what retirement advice was actually optimized for. The industry grew up helping people accumulate. The fee structures, the product design, the marketing, the seminars at the hotel conference room, all of it was about getting money into accounts. Advisors got paid on assets under management during the accumulation phase. The distribution phase was almost never modeled with the same rigor, and nowhere was that gap more expensive than in what I'm about to describe. Beyond federal income tax, RMDs can raise your Medicare Part B and Part D premiums through the income-related monthly adjustment amount, commonly called IRMAA. Medicare uses a 2-year look-back period, meaning your 2025 income will determine your 2027 Medicare premiums. Here is how IRMAA works mechanically. If your modified adjusted gross income from 2 years prior exceeds certain thresholds, your Medicare Part B and Part D premiums increase significantly. The extra expense for 2026 can range from $284.10 to $689.90 per month for Medicare Part B alone, depending on how much your income exceeds the threshold per person. If you and your spouse are both on Medicare, a single income event can trigger surcharges for both of you simultaneously, one household income spike, 2 bills. You might think IRMAA won't apply to you, since your income in 2026 has to exceed $109,000 as a single filer and $218,000 as a couple. And it's based on your earnings from 2 years prior for 2026. It's your 2024 income. Here's why that matters. At the worst possible moment, you retire at 68, income is modest for a few years. Then at 73, the first required minimum distribution hits. Your IRA has been compounding for years. That RMD might be $50,000 to $70,000 sitting on top of Social Security. Your combined income crosses $109,000. 2 years later, it is now 2028. Your Medicare premium notice arrives higher for the entire year, both of you. And you are completely unable to appeal it because investment income changes, large IRA distributions, and Roth conversions are not qualifying events for an IRMAA appeal. IRMAA functions as a cliff, not a gradual ramp. Going $1 over a threshold costs the same as going $10,000 over. If your income crosses into the next bracket by $1, your Medicare premiums can suddenly jump by over $1,000 per year. If you are married and filing a joint tax return, and both of you are on Medicare, $1 more in income can make Medicare premiums jump by over $1,000 per year for each of you. Here's a case from a 2026 analysis. A 73-year-old retiree with a $1.9 million traditional IRA faces a mandatory $71,698 withdrawal in 2026 that, combined with $42,000 in Social Security, pushes her gross income to $114,000 and triggers the $109,000 Medicare premium surcharge threshold. This adds roughly $1,050 annually to her Part B and Part D costs, with a cumulative 5-year impact approaching $3,500. Because IRMAA is a cliff, a single planning misstep, a large Roth conversion, a property sale, an unexpectedly large RMD can push a household into the next tier and lock in higher premiums for 12 months. And because the tax year is 2 years removed from the premium year, the consequences arrive after most people have forgotten what triggered them. The psychological dimension of this is worth stopping on for a second. IRMAA was designed to be invisible until it hits. The 2-year delay disconnects cause from effect in a way that makes attribution nearly impossible for most retirees. You take an IRA distribution in 2026, you pay the income tax. Fine, you move on. Then in 2028, your Medicare premium goes up. You assume it's just inflation. You assume everyone's bill went up. You have completely forgotten the 2026 income event that caused it. The system rewards forgetting. Here's a brief scene that captures this exactly. Imagine a retired engineer explaining his Medicare bill to his adult daughter in late 2028. She asks why it went up. He genuinely doesn't know. He says it must be the new policy. She looks it up. It's IRMAA, based on his income from 2026, which included his first required minimum distribution, which nobody told him would trigger a Medicare surcharge. He nods slowly. Well, he says, that's disappointing. His daughter writes the check. That is the third toll booth, and it was never on the map they gave you. Most Americans have the majority of their retirement savings in pre-tax accounts. Mandatory income from required minimum distributions can push retirees into higher federal tax brackets, trigger the taxation of Social Security benefits, and raise Medicare premiums by thousands of dollars each year through IRMAA. This layering effect, ordinary income, IRMAA, NIIT, capital gains compression, creates what many advisors call the retirement tax bomb. Let me now show you a fourth mechanism that extends this same system to the next generation, because the deferred tax liability doesn't disappear when you die. This is where the story gets genuinely interesting. And I mean that with all the amused disappointment I can muster. Before the Secure Act of 2019, when you left your traditional IRA to your children, they could stretch those distributions over their own lifetime. They take small, required minimum distributions each year, keeping the tax hit manageable. Congress eliminated that. Non-spouse beneficiaries who inherit an IRA after January 2020 now have 10 years to empty the entire account. Full stop. No annual minimum amounts required. But the entire account must be drained by year 10. Think about who your kids are when they inherit your IRA. They're probably in their 40s or early 50s. They are in their peak earning years, the 32 or 37% bracket. Every dollar pulled from that inherited IRA stacks on top of their existing salary, their investments, their everything. The same tax torpedo that hit you at 73 now hits them in their best earning decade, at the highest possible marginal rate, in the years when they have the least flexibility to absorb the income spike. The account you spent decades building as a gift to your heirs is, under current law, a 10-year IRS payment schedule delivered to your heirs with the tax bill attached. The government deferred that tax for 40 years. It never forgave it. It simply decided where and when to collect, and it engineered the answer to be at the worst possible time for the next generation. One of the biggest tax planning challenges in retirement is how different income sources stack on top of one another. That stacking doesn't end with your death. It transfers. Now let me build this into a concrete case study so you can see the full picture with your own financial profile in mind. Meet Mark. He's 52 years old today. He has $500,000 in a traditional 401k. He contributes the 2026 maximum of $24,500 annually, and his employer matches 3% of his $95,000 salary, roughly $2,850 per year. Contribution limits for 401ks rise to $24,500 for 2026. He has about $30,000 in a Roth IRA he opened a decade ago, but doesn't feed regularly. He plans to retire at 65. Scenario A. Mark keeps doing exactly what he's doing. At 7% average annual return with continued maximum contributions and employer match, his 401k reaches approximately $1.5 million by 65. He claims Social Security at 66 for $30,000 per year, roughly average for his earnings history. He does no Roth conversions in retirement because nobody models them for him. His IRA keeps compounding. At 73, his balance has grown to approximately $1.8 million. His first RMD? Approximately $68,000, using the IRS divisor of 26.5, combined provisional income with Social Security, roughly $93,000. All 85% of his Social Security benefits is taxable. His effective marginal rate on any additional withdrawal is well above 35%. And he crosses the first IRMAA threshold for single filers $109,000 in his first year of Social Security plus RMD income. Medicare premiums go up 2 years later. He pays elevated Part B costs for the next decade as his RMDs keep growing and the divisors keep shrinking. Over 15 years of retirement, the tax and premium drag compared to a well-planned alternative is conservatively $8,000 to $12,000 per year. Compounded, that's a six-figure difference in lifetime retirement income. Scenario B, between ages 52 and 65, Mark converts $30,000 to $40,000 per year from his traditional 401k to a Roth IRA in years where his income is predictable and his bracket is manageable. He pays tax at 22 to 24% now in a controlled environment, rather than at 40.7% later in an uncontrolled one. He still retires with a healthy nest egg, but the traditional account is smaller. His RMD at 73 is lower, perhaps $35,000. His provisional income stays below the first Social Security taxation threshold. No torpedo, no IRMAA cliff crossed. The Roth IRA generates no RMDs during his lifetime, grows entirely tax-free, and produces tax-free distributions for him in the years he needs it. When his children inherit the Roth after his death, they drain it over 10 years with zero ordinary income tax because it was already taxed when he converted it. Same lifetime income, same investment discipline. Scenario B costs him slightly more in tax during his working years. It saves him enormously in his 70s. The difference is not investing skill. It is understanding that the 3 toll booths of the retirement tax system are all avoidable if you position before you arrive at them. The toll booth is never where they said it was, but once you know where it actually is, you can reroute. Now, let me give you the subplot resolution I promised earlier. The question at the heart of this entire video is whether the advice that made the retirement savings industry wealthy actually optimized for you. The answer is nuanced and unsatisfying. The accumulation advice was not wrong. Tax deferral is mathematically advantageous during your working years in most cases. But it was sold as a complete solution. It wasn't. The distribution phase has a completely different tax architecture than the accumulation phase. And the architecture of the distribution phase contains 3 toll booths: Social Security, provisional income taxation, the RMD, Social Security stacking, torpedo, and IRMAA Medicare surcharges that the standard accumulation model never accounted for, because the people who designed the advice were optimizing for the phase they got paid on. The subplot is resolved. Traditional retirement advice didn't fail you. It just only told you half the story. Here is what to do about it, in 3 specific moves, calibrated only to what we just covered. The first move: run a Roth conversion ladder in the window between retirement and age 73. If you retire at 62 or 65 and have a decade before RMDs begin, that is the cheapest, quietest window you will ever have to move dollars from pre-tax to post-tax. You control the income. You can convert up to the top of the 22% bracket or even the 24% bracket each year. You pay a known rate now. You permanently remove those dollars from the RMD calculation. Every dollar converted is a dollar that will never appear in provisional income, never pull Social Security into the taxable column, and never count toward IRMAA. Converting roughly $160,000 per year for 10 years pulls the entire pre-tax balance into a Roth IRA where there are no RMDs during your lifetime. By 73, your traditional balance is zero, your RMD is zero, and the Roth grows tax-free for you, your spouse, and ultimately your heirs. The math is not subtle. Neither is the result. The second move, model IRMAA exposure 2 years out, not just your income tax bracket. Most people run their tax projections for the current year. Almost nobody runs the Medicare premium impact of a current year income event 2 years forward. The Medicare IRMAA 2-year look-back rule requires the Social Security Administration to set your current premium based on your tax-reported modified adjusted gross income from 2 years prior. Anytime you are considering an income event, a Roth conversion, a property sale, an inherited IRA distribution, an unusually large RMD, you need to know whether that event will push your 2028 or 2029 premiums into the next IRMAA tier. Reducing IRMAA almost always means managing the magi of the year being measured. So 2026 IRMAA is shaped by 2024 income choices. The cheapest dollar of planning is always the one that keeps you under the cliff, not the one that tries to appeal the bill after you've already fallen off it. The third move, if you are over 70 and a half and you give to charity, restructure every dollar of that giving as a qualified charitable distribution from your IRA. For retirees age 70 and a half or older, qualified charitable distributions allow up to $111,000 per person in 2026 to be transferred directly from an IRA to a qualified charity. QCDs can satisfy all or part of an RMD while excluding the distribution from taxable income and the provisional income calculation. That distribution counts toward your required minimum distribution. It never appears in your adjusted gross income. It doesn't touch provisional income. It doesn't feed IRMAA. It doesn't drag Social Security into the taxable column. For people who give to charity anyway, the QCD is one of the only completely legal IRS-approved mechanisms for satisfying an RMD without triggering any of the 3 toll booths. A $20,000 QCD on a $72,000 RMD shaves the taxable portion to about $52,000 and can drop you below the IRMAA cliff entirely. The government designed this system over 40 years. It deferred the tax collection with tax-deferred accounts. It built mandatory withdrawal schedules. It froze the Social Security thresholds. It attached a 2-year delayed Medicare premium mechanism. It rewrote the inheritance rules so the next generation drains the accounts in their peak earning years. Every single piece of this architecture was either designed or maintained to maximize eventual tax recovery on decades of compounded deferred income. The $48 trillion sitting in American retirement accounts represents the largest pool of deferred tax liability in human history. The IRS knows exactly where it is. It has a clock on every single account. Planning is not optional. It is the only mechanism for navigating the toll booths that were never on the map. Lazy investing built more fortune than crypto memes. But lazy tax planning will give back everything you gained, one toll booth at a time.